Welcome back to the Legacy Radio Network. I'm Dennis Tubbergen. This is the Everything Financial Radio Show. Thanks again to Mr. Mish Shedlock for joining us and giving us his views on Europe. And to continue in that vein, Europe had a really bad day last week, as Mish alluded to. Standard & Poor's downgraded the credit ratings of 9 Eurozone countries. This was outlined in an article published on MSNBC on January the 13th. The title of the article, S&P cuts credit ratings for 9 European nations. Well, France and Austria lost their AAA status. Germany, however, kept their AAA status. And if you listen to what Standard & Poor's commented about in the press release announcing these downgrades, they said that today's rating actions are primarily driven by our assessment that the policy initiatives that have been taken by European policymakers in recent weeks may be insufficient to fully address ongoing systemic stresses in the Eurozone. Well, what does that really mean? Well, we've talked about the fact that really what we have worldwide is an excess debt problem. And when we talk about economic cycles, excess debt typically is purged from the system during the winter season, as we'll talk about. And we think we're in the winter season in this wave cycle. So when we talk about this debt problem, really the European policymakers haven't taken steps to address the debt problem. In fact, there's only 2 ways to address debt. If you have debt, you have 2 choices. You either pay down the debt by making interest payments and principal payments, or you elect not to pay the debt. There's only 2 solutions. You pay it or you default upon it. Well, what the European policymakers have tried to do is inject liquidity, inject new money into the system. Well, that doesn't make the debt problem go away. It, in fact, makes the debt problem worse. It exacerbates the debt problem. And you can't solve a debt problem by injecting liquidity. I've used the example on past shows that if you know someone that's in a lot of debt and they've got bigger monthly payments to service the debt than they have in income, you can give them some liquidity. You can give them some cash this month so they can make their payments, but next month they've got the same problem again, and that's really what's going on in Europe. Well, that was bad news for France and Austria because now their credit rating is on par with the credit rating of the United States. Now, S&P also lowered its long-term rating on Cyprus, Italy, and Portugal and Spain by 2 notches. And Italy now, here's the bad news if you live in Italy. Italy has so much debt that their credit rating is BBB+. That's triple B+. That is the same credit rating as Kazakhstan, home of Borat. You might remember the movie Borat. And I'm not sure that was actually filmed in Kazakhstan, but if you're Italian and you've seen the movie Borat, to know that you have the same credit rating as Kazakhstan has to be keeping you awake at night. But that's better news than if you happen to be Portuguese. Portugal's debt is now considered to be junk. And as we talked about at the opening of today's show, Greek debt rose to over 400%. That's right, over 400%. That means that, theoretically speaking, if you were to loan the Greek government $100 today, in 1 year you'd get back, at the time I'm recording this show, about $420. Well, that means that investors have pretty much determined that it's likely that Greece defaults sometime in the next few months. I remember talking earlier last year on the Everything Financial Radio Show that 1 year Greek government debt was over 20% and how it was a slippery slope. I never imagined that we would see over 400%. Now, what happens? Because one of the things that I've predicted for going on probably 8 or 9 months now is that sometime this year in 2012, the euro will cease to exist in its current form. And we talked about that with Mish Shedlock as well in the last segment. Well, what would happen if Greece were to exit the euro? Well, Reuters of the UK ran an article back on January the 12th, and the title of the article was Greece Euro Exit Worse Than Catastrophic. And this is a bit from the article. A London-based hedge fund, Tosca Fund, had some comments about what would be the consequences of Greece leaving the Eurozone. Well, this is from the article. A Greek exit from the Eurozone would be worse than catastrophic and could provoke greater social unrest, Zimbabwe-style inflation, and a military coup, said London-based hedge fund firm Tosca Fund. Now, in a stark note to clients, the article says, chief economist Savas Savori said that introducing a new currency instantaneously into the wake of a euro exit would be impossible, and the delay would lead to a run on banks and evacuation of capital that would make what has already been seen as nothing by comparison. Savori said the word catastrophic would not do it justice enough. He went on to say those who imagine some post-euro exit stability would be restored quite simply fail to understand the magnitude, the social, economic, and political magnitude of such an eventuality. Now, Angela Merkel, the German chancellor, said this past week was that the goal was for no country to leave the euro. At the same time, Germany's not going to be very excited about potentially tying its credit rating, the AAA credit rating that they now hold, to the financial outcome or economic outcome of Greece. Now back to the article, Mr. Savori of Tosca Fund said that he would expect the euro to remain the currency of choice in Greece, even if it left the euro, and for the official exchange rate with the euro to be quickly undercut on the black market. Mr. Savori predicted a range of problems for the country, from hyperinflation, extreme difficulty for the government in raising money on bond markets, and an evacuation of people able to leave the country, taking as much wealth as they can with them. Savori said that inflation in Greece would quite frankly spiral in a way resembling Zimbabwe's experience. He said the social unrest seen up until now in Greece would be nothing compared with what would be seen in the dawn of a new drachma. He said it wouldn't be out of the question to argue that at worst the rise of poisonous political extremists would be the best outcome if Greece were to leave the euro. Now, if you take a look at what's going on in Europe, certainly as Mish Shedlock shared with us on today's show, the fact that Greece may default creates a whole new banking problem and creates even bigger insolvency issues in other areas of Europe. Now, if we go back and take a look at 2006, just to change gears here for a moment, there was an article in the Australian published on January the 12th titled, "No Worries," sounds like a headline you might hear from an Australian paper, "Fed Misjudged U.S. Housing Bust." Now, if you aren't aware of this fact, we get an overview of what happens at the Federal Reserve meetings shortly after the meetings take place, but we don't get the transcripts of the meetings for 5 years. Now, in my view, that's crazy, and everyone should be talking to their elected official in Washington saying, we want the transcripts at the same time as we get the meeting overview. But going back to 2006 and taking a look at what Alan Greenspan and Ben Bernanke, who actually took over as chair of the Fed in 2006, and Timothy Geithner, who was actually president of the New York Federal Reserve back in 2006, before President Obama appointed him as Treasury Secretary, all had some very interesting comments from the transcripts of the Fed's 2006 meeting. Now, in 2006, this is a direct quote from Mr. Bernanke. "So far, we are seeing, at worst, an orderly decline in the housing market. But there is still, I think, a lot to be seen as to whether the housing market will decline slowly or more quickly. As I noted last time, some correction in this market is a healthy thing, and our goal should not be to try to prevent that correction, but rather to ensure the correction does not overly influence growth in the rest of the economy." Mr. Bernanke also says, "In the March meeting, I think we are unlikely to see growth being derailed by the housing market, but I do want us to be prepared for some quarter-to-quarter fluctuations." Timothy Geithner at the March meeting said, equity prices and credit spreads suggest considerable confidence in the prospect for growth. Overall financial conditions seem pretty supportive of the expansion. Mr. Bernanke at the August meeting reminded his colleagues that the Fed has not been terribly successful with soft landings in the economy. Then he adds, we have a chance to get one here. Now, it's pretty amazing to me that when you take a look at the Case-Shiller Housing Index in 2006, certainly data that those at the Fed had access to, you could see that from January of 2000 through the time of the Fed meeting, we saw housing prices more than double over that 6-year time frame. Now, if I were to go to any of you and say, you know, the price of this whatever, house, car, gold, whatever, is going to double in a short period of time, you'd probably say that if it goes up that fast, it's likely to come down that fast as well. That's just common sense. What goes up must come down. At least that's usually the way it works. And yet, this group of intelligent folks looked at the statistics and concluded that a soft landing could even be in the cards. Now, sadly, this is much of the same group that is setting economic policy currently, attempting to solve a debt problem by adding more debt to the system. Can you get somebody out of debt by having them take on more debt? They're missing it again, and in my view, in 2012, as I outlined in my forecast, I think we could begin to see the consequences of what I believe is misguided policy. If you'd like to get a copy of the 2012 Market and Economic Outlook, you can go to investingapproach.com. That's investingapproach.com. We'll be back after these words. This is the Legacy Radio Network. Glad you're with me today. I'm Dennis Tubbergen, your host, and you are listening to Everything Financial Radio. If you'll forgive me for just a moment, I'm going to talk a little bit about an opinion. And let me tell you that if you don't agree with this opinion, I have plenty, so I'm sure there's one that you will agree with if you don't like this one. I'm from the government, and I'm here to help you. Boy, there's a lot of jokes out there that contain that line, but when the government gets involved in areas that should be left to the private sector, with government simply staying out of the way, unintended consequences can occur. The Wall Street Journal had an article this past week that I thought was very, very interesting, and it tied into a chapter in my book, Economic Consequences, that I title Unintended Consequences. Now, the article was published in the Wall Street Journal on January the 14th, and it was titled, How Stimulus Spending Ruined Buffalo, written by a gentleman by the name of Stephen Malanga. And a bit from the article. He asks at the beginning of the article, Mr. Malanga, why do cities like Buffalo decline, and what role should government play in promoting recovery? In his State of the State address this month, New York Governor Andrew Cuomo announced $1 billion in incentives to attract new investment to the beleaguered city by Lake Erie. Cuomo said, we believe in Buffalo and we'll put our money where our mouth is. Now, this is not the first time that New York has attempted to reinvest in Buffalo. In the article, Mr. Malanga says, ever since the city began losing its manufacturing base in the 1950s and gradually declined into one of America's poorest cities, the poverty rate in Buffalo today is nearly 29%. The federal and state governments have poured in hundreds of millions of dollars for projects like subsidized redevelopment schemes. And Mr. Malanga said they haven't really yielded any tangible benefits. Now, back in 2004, the Buffalo News estimated the city had garnered more federal redevelopment aid per capita than any other city in the country. A total of more than $500 million since the 1970s, yet the paper noted the city had virtually nothing to show for the investment. These schemes, in fact, these projects have often done harm. In fact, in the 1970s in Buffalo, the federal government decided to invest $530 million to build a 6.2-mile light rail system through downtown Buffalo. You can do the math. I don't know how many millions of dollars that is per mile, but it's expensive, and the politicians who put the project in motion theorized that it would further spur redevelopment. Well, in 1985, the project opened, and the rail line immediately fell well below ridership projections, and downtown businesses suffered because there was no traffic. A Buffalo landlord, I should say, in 2009 wrote, "Walk down Main Street on the Transit Mall, and aside from a few necessities like drug and cell phone stores, blight dominates." You know, investment subsidies rarely do work. You know, Buffalo also struggles, Mr. Malanga says, because it remains among the highest tax localities in the country. According to the Cato Institute, which is admittedly conservative-leaning, a Buffalo resident pays 25% more in income taxes than does the average resident in America's 100 largest metro cities. The city's school district is insolvent, and yet school teachers in Buffalo have insurance that pays for cosmetic surgery, elective surgery. John Fazo, a former member of the control board, which lobbied unsuccessfully to have elective cosmetic surgery perks ended, said that it continues today, and Buffalo school teachers are spending $6 million a year on elective cosmetic surgery, and yet the city is broke. Now, Buffalo isn't the only city to suffer from government intervention. You know, the city of Detroit was a model city when President Lyndon Johnson in 1966 initiated the Model City program as part of his Great Society program. And about $1 billion was poured into the city of Detroit. What's the result, Ben? By the mid-1990s, the Model City area lost 63% of its population and 43% of its housing units after this big investment. The Census Bureau at the last census reported the city population in Detroit fell by 25% over 10 years. The last time Detroit's population has been as low as it is today was after the census of 1910, before automobile production in Detroit started. See what happened after the Model City program was initiated. Immediately, 22,000 middle and upper class citizens moved out of the city. They just didn't like paying higher taxes and being told what to do. Instead of coming to the realization that this type of central planning doesn't work, in 1974, the program was expanded under the Community Development Block Program, and now the population of Detroit has fallen further. So before Mr. Cuomo invests any more taxpayer money in Buffalo, he might want to study what happened in Detroit when politicians decided to once again invest in the city and take another whack at government investment to create a desired outcome. They missed twice, and Buffalo likely will too, in my opinion. So I'd advise Mr. Cuomo to save his money. In fact, he might even have more success if he were to just eliminate all state taxes in Buffalo for a period of time. And there's one other thing: he'd have to stay out of the way, which is the difficult part for a lot of politicians. Now, if you're just joining us, this is the Everything Financial Radio Show. If you've not attended a discovery group where we talk about the economy, we talk about your money, and in just a moment I'm going to talk to you about economic cycles. You can go to personallegacyseminars.com and see when we're going to be at a location near you. Also, if you'd like a copy of our 2012 Market and Economic Outlook and what it might mean for you and your money, go to investingapproach.com. That's investingapproach.com. We'll be glad to send you a complimentary copy of that report. One of the things that we talk about in that report is the whole idea of economic cycles. And as I said at the top of the show today, back in 1925, a Russian economist by the name of Nikolai Kondratiev published a book titled The Major Economic Cycles. Now, in the book, Mr. Kondratiev stated that it was his opinion that capitalist economies move in boom and bust cycles, with each full cycle repeating itself every 60 to 80 years approximately. Mr. Ian Gordon has really expanded upon Mr. Kondratyev's work, and he has named these cycles, these 4 subcycles, after the 4 seasons of the year: spring, summer, autumn, and winter. And we believe that after a study of economic history, Mr. Kondratyev's cycle theory is accurate. Now, if you think about the cycles, we think that we are currently in the winter cycle, and during winter, an economy experiences credit problems, money becomes scarce, financial institutions get in trouble, there are unprecedented levels of bankruptcy at the personal, corporate, and government levels, there's a credit crunch, there's an international monetary crisis, and there are pension funding problems, and we see the price of gold and gold-related equities rise. Now, we think we've been in the winter cycle since 2001, and it's going to take some time to work our way through the winter cycle and deal with the debt. Well, how did we get to the winter cycle? Well, we get there because of what happens during the autumn cycle, and we think the autumn cycle occurred from 1983 to 2000. During this time frame, money's plentiful, gold prices fall, and during autumn there's often a massive stock bull market. There's speculation, there's financial fraud, real estate prices rise because of speculation, debt levels reach astronomical levels, and consumer confidence is at an all-time high due to high stock prices, high real estate prices, and plentiful jobs. But all this debt has to be purged from the system, and that's why we believe we are in the winter cycle. You know, we live here in Michigan, and we believe that to use the seasonality analogy, if you were to go plant a garden in the winter and expect something to grow, everybody would say that's crazy. Wait until spring because things grow best in the spring and summer, and you harvest in the autumn. And we think, as we talk about at our discovery groups, that certainly in the winter cycle, it's important for you to think about protecting and preserving capital, and there will be limited growth opportunities. And we talk about this at our discovery groups where we talk about these cycles in detail. We talk about which cycle we're in, when we see the cycle ending, and what you should be doing during this winter economic cycle. Again, go to personallegacyseminars.com. That's personallegacyseminars.com to get information about a discovery group in your area. We will be at multiple locations all around West Michigan. And also, if you'd like, in writing, our view of where the economy is and, more importantly, where we see things going in 2012, you are free to go to investingapproach.com and request your complimentary copy of our 2012 Market and Economic Outlook. Just give us your name and address. Let us know where to send it, and we'll be very glad to do that. Thanks for joining us this week. Tune in again next week, and we'll talk more about the economy and your money. See you then.